Hello, everyone. I hope you were all doing well today. This is Dexter, one of the loan officers at Commercial Lending USA. Today, I and my senior associate Charles will be leading the presentation on DSL loans. If you have any questions during the presentation, feel free to ask at the end of the presentation or email our loan scenario address, which will be shared at the end of the presentation. I think most of you are familiar with residential DSCR qualification. So today we'll focus on commercial DSCR loans, and we will also cover alternative options in case a loan doesn't meet DSCR guidelines, helping you to better qualify for loans under the right programs and close more deals with our full support. And I highly encourage everyone to attend our upcoming training sessions for a better understanding of commercial mortgage loans. Okay, then, let's get started. These are the agendas for today. We will try to give you the idea about the DSCL loans, its features and benefits, along with the loan qualifications, calculations of the ratio, difference between residential and commercial DSCR loans, other alternative loan options, comparing between DSCR, conventional, and light dock, and finally, why our company may be one of the best solutions. So, what is DSCL loans? It actually short for debt service coverage ratio loan. It's a type of non-qualified real estate financing that focuses on a property's income potential rather than the borrower's personal income. These loans are especially popular among real estate investors as they allow for portfolio growth by qualifying based on the property's cash flow instead of traditional income documentation. The debt service coverage ratio itself is a key financial metric used by lenders to assess whether a property's income is sufficient to cover its debt obligations, such as loan payments. Okay, so what are commercial DSCL loans? Well, commercial DSCL loans focus on a property's income generating ability to determine repayment capacity rather than personal credit. The DSCR is calculated by dividing the property's net operating income by its debt obligations. A ratio above 1 indicates that income exceeds debt payments. This loan type is ideal for real estate investors, emphasizing cash flow to enhance lender confidence in the investment. Okay, now we'll discuss the interpreting the DSCL loans. Actually, a higher debt service coverage ratio indicates better repayment capacity and is preferred by the lenders. Typically, a DSCR of at least 1.25 is sought for commercial properties, reflecting lower risk, greater financial stability, and increased protection against economic downturns. Well, at this point, we'll be discussing with some features of commercial DSCL loans. Basically, commercial DSCL loans have unique features that differentiate them from traditional commercial loans. Like at first, here we can see property performance focus. Commercial DSCR loans prioritize the property's income generating potential over the borrower's credit history and financial standing, concentrating on its ability to cover debt service rather than debt to income ratios. Secondly, flexible underwriting. DSCR loans features more adaptable underwriting standards, allowing borrowers who may not qualify for traditional financing to access funding, thereby broadening opportunities for investors in commercial real estate projects. Then, lower loan to value ratios. For DSCL loans, lenders typically require lower LTV ratios, necessitating larger down payments from borrowers, because this approach ensures that borrowers have more equity in the property, thus reducing the lender's risk exposure. Then, if we talk about shorter loan terms, DSCL loans usually feature shorter term than traditional commercial loans, enabling lenders to ensure consistent debt service coverage throughout the loan duration. This structure helps verify that the property can consistently generate sufficient income to meet its debt obligations. That's it. So basically, these are the features of commercial DSL loans. Okay, here we can see some benefits of commercial DSL loans. At first, we can see flexible repayment terms. Actually, DSL loans allow customizable repayment schedules that match a business cash flow, unlike traditional financing with rigid timelines. Then it also increased borrowing capacity. DSL loans prioritize cash flow, enabling borrowers to qualify for larger loan amounts than they might with traditional financing. And again, lower interest rates with reduced risk. In commercial, DSL loans generally actually provide lower interest rates compared to alternative like bank statement or no doc loans. This makes them a more secure and cost effective financing options for borrowers. Well, why DSCR is smarter financing for investors? Because DSCR loans enable investors to use property cash flow for larger loans, focusing on income potential over personal credit, as I mentioned before. This flexibility supports portfolio growth while reducing financial risk. Well, how do we calculate DSCR ratio? This is basically the formula to calculate DSCR. The debt service coverage ratio measures a property's ability to meet its debt obligations, as I mentioned before. It is calculated by dividing the net operating income or income after expenses by the total debt service, which includes principal and interest payments. Where here NOI, that means net operating income, it actually the total revenue minus the operating expenses. Then here the debt service, it actually means the current debt obligations. A DSCR, when a DSCR greater than 1, that indicates the sufficient income to cover the debt payments. Well, we have to know actually that what kind of properties will be qualifying for a DSCR loans. Here we can see the multifamily properties, office buildings, retail properties, industrial properties, hospitality properties, even mixed use, and the residential investment properties. are these kind of properties that can be qualified for getting the DSCR loans depending on the income that are being generated by the properties. Well, of course, we have to know about some factors that impacts on DSCR loans, which crucially affects on DSCR loans as well. So here, at first, the borrower needs to have at least a 660 FICO, and the property type needs to be determined and need to check with the interest rates to qualify. Then the ratio and terms are another important aspect to look into. And of course, the property condition and the location plays another vital role here. And lastly, need to determine the risk of making an investment in the properties through DSCR. Okay, here we'll see actually who will be eligible for a DSCR loan approval. DSCR loans are designed for borrowers who may not qualify through traditional income verification but have strong income generating properties. Like here, we can see self-employed individuals, actually those with variable income streams who may not show consistent earnings on tax returns. Then if we talk about for business owners and contractors, entrepreneurs who rely on business cash flow rather than W2 income, the real estate investors, individuals or entities with rental or commercial properties that produce state income, and the foreign nationals, actually in this case non-US residents actually who has valid visa for living in US. Only they can qualify based on the property's performance, not on the citizenship or credit history. Then borrowers with significant liquid assets, like high asset individuals who may not have traditional income but possess strong financial reserves. Then the borrowers with less taxable income, that means those whose income is not fully reflected on tax documents but on profitable rental properties. Well, here actually we're trying to make a comparison between private lenders who provides DSCR loans and agency lenders, as we all know that they provide Fannie Mae, Freddie Mac. So here, firstly, private lenders actually provides based on the property income, where the agency lenders provides on basis of borrowers' personal income, financial strength, and DSCR ratio. Then, for private lenders, the loan purpose could be for purchase or refinance rental, where for agency lenders, broader purposes are allowed. And private lenders basically requires 20 to 25% down payment, whether the agency lender require 15 to 30%. Then the DSCR ratio usually 1 to 1.25 for private lenders, and on the other hand, agency lenders require 1.25 to 1.55. And here we can also see the loan limits could be 1 million to 50 million provided by the private lenders, where agency lenders could provide 1 million to 200 million plus. Always depends. And usually the private lenders are faster than the agency lenders in terms of closing. Even private lenders sometimes charges a bit higher rate than the agency lenders. Private lenders typically require personal guarantor. On the other hand, for agency lenders, non-recourse is available. And last thing we can see here, private lenders allows unlimited properties, but there is restrictions for agency lenders who allows limited properties. Well, now we will discuss actually who should use DSCR loans. DSCR loans are designed for income generating properties, as I mentioned before, making them a great fit for rental and commercial real estate. They can also be used for refinancing existing properties, providing property owners with flexibility to enhance their financial strategies. Well, this is very important. We have to know that which kind of properties won't be suitable for DSCL loans. Those could be raw land or project development, fix and flip or ground up construction. Of course, high risk properties won't be eligible for that. A vacation or personally use, any properties like that are unique or non traditional properties, irregular income properties, of course. Yeah, this kind of properties actually won't be suitable for DSCL loans. Well, so that's all from my end. Now, I would like to invite our senior associate chairs to cover the rest of the session. Thank you, everyone, for being with me.
Thanks, Dexter, for giving me the floor. You did well in covering the most of the aspects of the DSCR loan. Let me cover the rest. Let me share my screen with you guys. Okay, so hello everyone again. Thanks for bearing with us this far. Um, so let's continue with the rest of the training session. So here, what we are trying to show you is what happens if the DSCR loan does not qualify. So we have an alternative loan program, as we can say that as a bank statement loan program, which basically is designed for self-employed individuals and maybe others with like a non-traditional income who are struggling to qualify for a conventional loan, maybe based on W-2s or maybe on basing on like tax returns. This option is particularly beneficial for borrowers who are operating a business, maybe from the location and occupying most of the space, especially if they do not meet the criteria for full documentation or DSCR loans. So instead of relying on tax returns or the DSCR ratio, lenders evaluate 12 to 24 months of personal or business bank statements to assess the cash flow and determine qualifying income. We can qualify the borrowers in this program for up to like 75% loan to value with a minimum credit score of 660, of course, but this can come with a 30-year loan term, and the range of the loan may be around 205K to over 5 million. And the most suitable like properties could be commercial buildings for this program. So other alternative program, as we can see, it's light doc or no doc loans, or the light doc and no doc loan programs. These are basically designed for borrowers with non-traditional income sources, or maybe the borrowers who are encountering difficulties in providing extensive documentation. You already know, like whenever we move into a loan program, we may require some documentations additionally to process through a loan program. That case, these programs require significantly less documentation than the conventional loans. And this typically allows for minimal proof of income, such as profit and loss statements, maybe projections, or no income documentation at all. Um, Approval basically is based on common sense underwriting through this program. These actually emphasize the credit worthiness, equity, and the property value. And we can offer like both short-term and long-term loans with a maximum loan to value ratio could be going up to 75%. And of course, here we check if the credit score is at least 660. So here is another alternative loan programs, which we can call portfolio commercial loan. which is basically designed for real estate investors and businesses to finance multiple commercial properties or a single complex property under one loan. Um, Held in the lender's portfolio, these loans offer greater underwriting flexibility. And if we check with some key features of this loan, what we find here is purpose-specific funding, which basically for allocating the property development or maybe for construction. We can also have the collateral based. This is basically secured. The loan is secured by the property itself. This may be in between short to medium term, typically 1 to 5 years, often with coming with interest-only payments. And this can have a high interest rates because this reflects the increasing in risk. The draw schedule could be funds could be disbursed in stages based on the project progressing. If we move with the DSCR requirements, this basically to ensures income covers the debt obligations, and this has to have a clear exit strategy because lenders require a repayment plan, maybe sale or maybe a refinance to exit the loan. So if this current or if these criteria aren't met, borrowers may need to explore some alternative financing options or make some adjustments to their project plans. Okay, so here we are checking on another alternative program, which we call it projection-based loans. These are designed depending on the projections that are maybe making by the investors for some certain projects. And this works best for the real estate investors typically. And these real estate investors basically look to get financing all at once in their multiple properties. The features of this loan actually benefits the investors to get the loan at once for all the properties instead of having the loan split for different properties. And to have a flexible underwriting, to keep things simple and risk-free, lenders basically keep the loan in the portfolio instead of selling that. And there are some advantages of this loan. That is because there are some qualification process for this loan, which is relatively easier for multiple properties. Even this loan gives substantial support for the investors that are having significant rental portfolios. But we may have some disadvantages of this kind of loan because these types of loan generally have higher interest rates, and the lenders obviously look for a strong credit worthiness and substantial assets from the borrowers to support this program. Blanket loan, we may or we may not know about this, but this is actually becoming a common program for the lenders. This blanket loan basically a mortgage that finances multiple properties under one loan. And this is basically making a practical choice for basically the real estate investors and also with the developers. Some of the benefits could be one loan coming as a blanket loan. A loan is coming into one loan means there will be a single monthly payment for the multiple properties. So we can say it's just a simplified management thing. There are flexibility. A partial release clause allows for the sale of individual properties without settling the entire loan. Means, let's say there are 6 properties, an individual property needs to be sold. That can be sold without settling the entire loan payoff. And this is cost efficient because there are lower fees and interest rates compared to separating the loans, but we may also have some drawbacks as because the blanket loan basically is coming around we can say a cross collateralization. So there are risks. If there is a default, that default will reflect on all the properties that are involved in this program. And it has a higher down payment and to make more upfront for the capital. But as I said, this is ideal for investors and developers who are looking for streamlined financing and flexibility in managing multiple properties. Bridge loan. As I already have mentioned this before about the bridge loan, we already know what bridge loan is. We just are giving you a short just an idea what that could help. As because we already know, the commercial bridge loan, this is basically a unique lending solution, and it provides short-term financing for a commercial or residential investment property until a permanent financing can be secured. This could be in between 12 to 36 months term with principal interest or with the interest only. This loan actually designed to bridge the gap in between an upcoming expense and an influx of capital that indicates the current state of the property and more permanent financing, like maybe for DSCR or any other conventional loan. And this loan actually based on the current value of the property instead of its potential income. That being said, it gives the advantage to the properties that are basically in distress or may not be in full stabilization. Where traditional financing options basically require a steady income stream from the property or check the occupancy rate, but bridge loan checks the current value of the property instead of those. And bridge loans are quick to fund, depending on the lender and circumstance. Funds can be secured as soon as in between 21 to 30 days, as uh, Dexter already tried to mention. This type of funding can facilitate different types of property enhancements to increase the value and marketability. And enhancements maybe include like renovations, repairs, or other improvements, which could be essential for future stabilization of the property. Hard money loans. This is also a short-term loan, but as this is a short-term, it comes with a high interest rate. This is also a private lending form, and this is based on collateral rather than creditworthiness. And their structure often featuring high rates and balloon payment. That is why it makes them ideal for investors and developers seeking fast, flexible funding for high-risk projects that traditional banks are unwilling to support. Um, these types of loan can be typically sourced from individual investors or small lending groups. For this reason, they are totally different from the traditional bank loans in terms of like faster loan providing, more streamlined approval process, and this actually can play a pivotal role for the investors to show a pathway for like capitalization after making an investment on time sensitive opportunities. But this loan has some key advantages like flexible terms, negotiable repayment schedules, maybe with the interest rates and loan amounts. Loan is approved depending on specific needs and nature of the project and considerably quick to fund. All right. So here we actually try to make a comparison between the DSCR versus the bank statement loans. This is just to give you an idea. We may become later on with this in a detailed one, but we are trying to give you just an idea that how we can compare with the DSCR and the bank statement. So if we move with the DSCR, as I already mentioned, the qualification purely is based on the property's income, not the borrower's personal income, where in the bank statement, we see borrower's qualification is assessed based on personal income verified through a bank statement, and we typically require most recent 12 to 24 months of statements for review. In the DSCR, requires proof of property income, like through rental or operating statements, where in the bank statement, primary focus on cash flow reflected in the bank statements. And with this program, income is verified through bank statements rather than the tax returns. In the DSCR, this is ideal for real estate investors who actually are owning income generating properties. And instead of relying on personal income, this program focuses on the property's cash flow to determine loan eligibility. And this makes a great option for investors looking to expand their rental portfolio. But with the bank statement, this is ideal for the borrowers who are self-employed or have income from non-traditional sources. Okay, so we are trying to have like the DSA calculation. What are the fees that we need to move to calculate the SFH 1 to 9 units for the DSCR? This can include like the standard operating expenses. These are management fees, property management fees, repairs and maintenance fees, property taxes, insurances, HOA fees, utilities. But if the landlord include those, then it will come. So altogether, we can get the standard operating expenses that Dexter tried to make you understand on the calculation. Here, we try to make a difference between residential and commercial DSCR loans, as we have mentioned that residential DSCR and commercial DSCR. So we needed to address those and make a difference on those so that it will give you clear idea. So residential, what we check is a DSCR ratio of 1.2 to 1.25, where the commercial lenders usually prefer 1.25 to 1.55 if there are risk properties. That means a property must generate, let's say, more than 20 to 50% more than the debt payment it has. Then if we check, we will also find residential DSCR is for the residential investment properties that is generating income, where commercial DSCR typically used for larger commercial properties like office buildings, retails, or the properties maybe with the mixed use. This is easier to calculate a residential DSCR ratio, but in the commercial properties, we may often have additional income streams, which results in more complex operating costs that makes a complex DSA calculation for the commercial properties. In residential, 1.0 DSCR can be considerable, or sometimes it can be said there is no ratio calculation. But for the commercial, the minimum is what we look for is 1.25, and that can increase depending on the loan type, borrower's credit profile, and the property's stability. Now we are trying to have a comparison in between conventional DSCR and no-doc loans. So according to qualification, if we check the DSCR, as we already told, based on the property rental income and debt, where traditional comes with the borrower and property income as we tell as a full doc, and with the light doc and no doc, just a common sense underwriting is required where this is not based on the income. If we check, DSCR typically comes with higher than traditional loans, but traditional has the best interest rates with long-term financing. Light duck no duck has easy approval, but it has more interest rates than the DSCR, the higher one. If we check with the loan amounts, those could be in between for DSCR 250K to 200 million based on the ratio, where traditional can go 2 million to 200 million based on the financials, and on the light duck no duck, where both bridge and term loans can go 250 up to 50 mil. DSCR can be approved within 30 to 45, where traditional normally takes 60 to 90 days, but if it comes through the FHA commercial, it can take in between 3 to 12 months, where light dock and no dock takes 25 to 45 days. DSCR has flexible terms when the ratios are matched, but traditional, they're more stringent requirements. And with the light dock, no dock, as we said, has more flexibility and easier terms, and they have easy approvals. So the question comes obviously, why the borrower or any broker or any other people will be coming, or maybe any other investor who are investing in the properties will come to us to get that help. So as I mentioned before, try to let you know that we do have experienced funding specialists to help out the borrowers, and we do have over 30 years of combined experiences, and we have a wide range of loan products that may help the borrower to look for their exact needs. We have our support team available for 7 days a week to meet with any queries or solutions they might look for, and we are able to issue the letter of intent within a short time, as we have in-house underwriting ability and have relationship with over 200 investors and lenders. The borrowers, without any doubt, will get better funding and will get every kinds of assistance to make their funds available, as we have higher closing ratios. All right. So let's go to the frequently asked questions. So many questions definitely are on mine. We just try to show you some questions which can be answered, but though apart from those, there are more questions may come. So please bear with us. What DSCR is required to qualify for a commercial loan? As we said, for residential, 1.25, but can have a no ratio like 1.0 DSCR. But as we said, for commercial, 1.25 to 1.55, but that depends on the loan type, borrower's credit profile, and the property stability. What types of properties qualify for DSCR loans? Simply, all types of income generating properties, they're qualified for the DSCR loan. Those could be like, as Dexter mentioned, apartment building, retail centers, office buildings, industrial warehouses, hotel motels, and mixed use properties as well. Are DSCR loans only for experienced investors? Um, This loan is available for both experienced and first-time commercial investors. But this needs to be mentioned that the experienced can get the benefit out of this loan. To get a favorable term, this is essential to show a proven track record with the experienced investors. Can DSA loans be used for construction projects? Some of the DSA loans are structured for the projects for construction or maybe for renovation, but those should have a projection of income prior project completion. In these cases, the detailed construction budget, project finish timeline, and post-construction DSCR projections, these things should be submitted to the lenders so that they can calculate and move forward. What are the typical interest rates for DSCR loans? Basically, the rates for these loans vary. The variation can depend on several factors like different lenders, property type, or market conditions. But whatever the rates are, they're competitive with other commercial loan producers. Basically, the borrowers, those have high DSA ratio, property with excellent locations, and stable income can get qualified to get lower interest rates. Can I refinance an existing loan with a DSA loan? Certainly. Many of the investors use this loan to have a refinance their existing debt on a property. Um, the refinancing with this loan actually helps to secure a better interest rates, having a reduced monthly payments, or there will be the opportunity to have excess equity for additional investments. Can a DSA loan be used to purchase multiple properties? Definitely. Depending on the income generation that are coming from the portfolio properties, this DSL loan can be structured. Um, in this case, like a lender's check, if the entire portfolio is generating enough income by assess the combined DSCR of the properties. That's basically to make sure that the income from the properties can cover the debt obligations that will be coming on. Is a DSL loan right for my investment property? Um, this loan is ideal for the properties that have stable cash flow, as we already mentioned. That means for the income generating properties, this DSCR will be the right solution. Let's say a property has its occupancy rate at its highest, for example, 90% or 95%, or maybe 100%. Its rental income is consistent, then a DSCR loan can be offered with attractive terms, definitely. And this will basically helps to move forward by not depending on the personal income documentation or any kind of statements. All right, so we have explored the DSCR loans and alternative options for borrowers who do not qualify under specific loan programs. While we may be not the best solution or may not be able to offer the best terms initially, but we can help find the right loan solution to close the deal. Borrowers have the option to refinance after a few years once the property and revenue stabilize. And in the coming weeks, we will also cover the SBA, USDA conventional, FHA, Freddie and Fannie. And we encourage to join our training sessions every Thursday at 4 p.m. Eastern, 3 p.m. CST. And I would like to thank you for attending today's training session.